Welcome to the Manual and Computerized Payroll Blended Learning course from the Shannon Training Center. In conjunction with visits to the Training Center, this video will take you through everything you need to comfortably complete the manual payroll section of the course. Each topic will be broken down in small sections, and you will be able to practice each one before moving to the next. There are 5 assignments in this course, 3 on manual payroll and 2 in computerized payroll. While this seems like a lot of assignments, passing each individual assignment is quite achievable and far easier than doing one huge assignment at the end of the course. The first assignment covers the basics of calculating payroll manually and is an excellent introduction to the fundamentals. The second assignment focuses on emergency and temporary tax. The third assignment looks at married versus single taxation, calculating PAYE with a pension, and some more payroll theory. Assignment 4 is an introduction to computerized payroll using Sage MicroPay. Assignment 5 covers more features of Sage MicroPay as well as monthly payrolls. So, let's get started. Manual payroll at its most basic consists of applying calculations to get from a gross pay figure to the corresponding net pay for an individual. There are 3 tax calculations that we will learn, each of which will be deducted from the gross pay to give the net pay. The first tax is called PAYE, which stands for pay as you earn. Currently there are 2 rates of PAYE, 20% and 40%. The second tax is called PRSI, which stands for pay-related social insurance, and this is the main source of funding for social welfare payments. The third tax is the USC, which stands for Universal Social Charge. The Universal Social Charge (USC) is a tax on income that replaced both the income levy and the health levy. So, we will focus on calculating PAYE first. Only when we have practiced the PAYE calculations will we proceed to the other 2. In this section we will introduce the standard rate cutoff point, otherwise known as the SRCOP. Currently there are 2 rates of PAYE, 20% and 40%. Each person is allocated a cutoff point by the revenue commissioners, and this dictates how much of your pay is at 20% and how much is at 40%. You pay 20% of your gross up to the cutoff point, and 40% on the amount of your gross above the cutoff point. It is important to note that when your gross goes over the cutoff point, it does not mean that all your pay is then taxed at 40%. Only the amount above the cutoff point is hit for 40%. At the start of each year, the revenue commissioners allocate each person their individual cutoff points depending on their circumstances. For instance, there is a set cutoff point for single people, another for married, etc. Working through an example of this calculation will help to explain the concept further. In this example, a person has a weekly gross pay of $1,000. They have been allocated an SRCOP of $800. Which means that $800 of the gross will be taxed at 20%, and the remainder, $200, will be taxed at 40%. The $200 was found by subtracting the cutoff point $800 from the gross of $1,000. 20% of $800 is $160. 40% of $200 is $80. Add the 2 together and the total tax due is $240. In example 2, the gross is lower than the cutoff point, so it is the $700 that is taxed at 20%, not the SRCOP, and there is nothing at 40%. So, while we have calculated the 2 rates of PAYE, we are not finished yet. Each person is given a tax credit. This credit has the effect of reducing the amount of PAYE that we must pay. The amount of the tax credit varies based on the circumstances of the taxpayer. To demonstrate the tax credit, we will first calculate the PAYE due on a gross of $1,000 with an SRCOP of $800. This comes to $240. We then subtract the tax credit of 80, and this leaves us with a final payout of 160. Example 4 shows a similar calculation with a higher gross of $1,200. Example 5 shows the calculations done when the gross is the same as the SRCO. Example 6 shows that in some cases, there may be no PAYE due at all. You will notice that the tax credit is larger than the tax due. This does not mean that you get a refund of 20. The actual tax due remains at 0. The 20 left over is carried forward each week and is available to use if the gross increases in future weeks in the current year. We will look at how this is calculated later on in this session. Finally, example 7 is just another similar calculation with a high gross pay figure. The calculations we have covered so far are not very complex. However, they form some of the foundations of the overall payroll calculations, and it is well worthwhile to practice them until they become second nature to you. So, please take some time to work on the exercises in the workbook and come back to this video when you feel you are ready. Previously we saw that an unused part of the tax credit can be carried forward and used later in the year if required. This is made possible by the cumulative nature of the system. In this section we will explore the cumulative payroll system. While almost all businesses now run computerized payroll, in the past it was often done manually. A tax deduction card was used to calculate and manage the calculations, and this TDC is still the best way to learn and understand the system. To understand the concept of cumulative figures, you can see the first column shows the gross pay non-cumulative. The second column shows the gross pay cumulative. The 500 is added on each week, so that the fourth week, for instance, shows the total of all gross pay for the 4 weeks. These two columns show that the SRCOP and the tax credit also accumulate. This example of a tax deduction card shows the cumulative system in action. The first column shows the week number, and the second column shows the pay date of that week. Then we have the gross pay column, which is not cumulative. It shows the gross pay on a weekly basis. In the cumulative gross pay column, the gross adds up each week as in the previous slide. The tax deduction card comes with the standard rate cutoff point and the tax credit already filled on a cumulative basis. The first week's pay is entered almost as if there is no cumulative system, as there are no previous figures to add to the current week. The cumulative gross is the same as the gross. The first 700 is taxed at 20%, which is the standard rate. The next 300 is at 40%, which is the higher rate. When we add both rates together, we get 260, which is the cumulative gross tax. We then subtract the tax credit of 70 and we are left with 190 payable. This is the cumulative tax, and because this is the first week, the tax deducted this period is the same as the cumulative tax. If we look at the second week, the cumulative gross has increased to 2,000 and the cutoff point and tax credit have also doubled. We will now use the same principle as before. We get 20% of the 1,400, which is 280. And 40% of the remainder, so 2,000 minus 1,400 multiplied by 40%, which gives us 240. Adding the two rates gives us 520, and the cumulative tax credit is subtracted to leave 380 in cumulative tax. This figure being cumulative means it is the total tax for the 2 weeks. If we subtract the previous week's cumulative tax from the current week, we are left with the tax deducted this period 190. Looking at the fourth week, we can see that the same principle applies all the way down. We get 20% of the 2,800 and 40% of 1,200. Add the results together and subtract the tax credit, and we are left with 760 in cumulative tax. Subtract the previous 3 weeks' cumulative tax of 570, and we are left with 190. Note: if the gross, the cutoff point and tax credit do not change each week, then the tax deducted this period should also stay the same. In this example, we have a gross pay of 800, a cutoff point of 700, and a tax credit of 70.38. See if you can follow the calculations as before. In example 2, we can see how the cumulative system provides for a refund. You will notice that the employee is on unpaid leave on week 4. Their gross pay is 0 for that week. The first thing to notice is that the cumulative gross pay has not increased from the previous week as there was no gross pay for that week. The second thing to notice is that the cumulative gross is now less than the cutoff point, so there is no 40% rate. Finally, you will notice that the cumulative tax is lower than the previous week's cumulative tax. When we subtract the previous week from this week, we are left with a negative 190. This is a refund of 190 and goes in the tax refunded this period column. The refund comes about because the cutoff point and tax credit have accumulated that week while the gross did not. This means that there are now 4 weeks of tax credit and cutoff point and only 3 weeks of gross pay, and the 190 refund balances that out. Take some time now to practice tax deduction cards in your workbook. It is very important to be proficient in this skill before moving to the next. The next payroll calculation is the PRSI. There are 2 types, employee PRSI and employer PRSI. We will go through both types in this session. The typical PRSI rate is 4% of the gross. However, an employee with a gross of 352 or less will not be charged PRSI. There is also a small reducing credit for any gross pay between 352 and 424. There are a number of different PRSI classes, but the most used one is Class A. A schedule of the other classes can be found at the end of your workbook. These 4 examples of PRSI calculations show how the 4% is applied. Once the gross goes over the 352, then all the pay is taxed, not just the amount above the 352. An employer pays PRSI on the gross. This figure is a cost to the employer in addition to the gross pay. A gross pay of up to and including $395 is taxed at 8.8%. Everything over $395 is taxed at 11.05%. And again, this is calculated on the entire gross, not just the amount above the $395 threshold. These 4 examples demonstrate how the employer's PRSI is calculated. Within Class A, there are a number of subclasses, and these are based on the amount of the gross. Paying PRSI overtime means that the employee is entitled to the benefits shown. Self-employed people are on Class S, and there are a lot fewer benefits available to them. In this example, the employee PRSI and the employer PRSI are calculated from the gross as before and then added together to show the total PRSI payable. Only the employee's PRSI is subtracted from the gross. While the PRSI calculations are not too complex, it is worth taking some time to practice them before moving to the next section. We will now add in the PRSI to the tax deduction card. PRSI is not cumulative. It is calculated on the weekly gross and it is entered in the TDC outside of the cumulative area. If the gross remains the same each week, then so too should the PRSI. There is a column for the total PRSI, which is the employee and employer PRSI added together. There is no column showing the employer PRSI only. The workbook contains a number of TDC exercises that includes the PAYE and the PRSI calculations. Take some time to practice them before moving to the next section. The last payroll calculation in this section is the Universal Social Charge, otherwise known as the USC. There are a number of different brackets and corresponding rates as shown here. For USC calculations, when the gross goes above a bracket, it does not mean that all the gross is taxed at the corresponding rate. Only the amount of the gross within the brackets are taxed at that rate. This will become clearer when we do some examples. If the gross is $13,000 or less, then no USC is charged. A USC payroll card is the best way to understand and to calculate USC. Cut-off points 1, 2 and 3 are already filled in, and we have filled in the gross pay for the first week for this exercise. The first 231 of that is calculated at 0.5%, which will always be 1.16. Then we subtract the first bracket 231 from the second bracket 393.92 and get 2% of the result. Then we subtract the second bracket 393.92 from the third bracket 1347 and get 4.5% of the result. The balance is at 8%, so we subtract the third bracket 1347 from the gross 1500 and get 8% of the result. We then add up the 4 USC figures and enter the result in the cumulative USC column. Because this is the first week, the cumulative USC will be the same as the USC deducted this period. The USC is cumulative, so in the second week the gross has doubled, as has the cutoff points. We get 0.5% of 462, 2% of 764.38, minus 462, and 4.5% of 2,694, minus 764.38. We use the cumulative gross for rate 4, so 3,000 minus 2,694 by 8%. When we add up the four amounts, we get 119.67, and again this is the USC for the first 2 weeks. We subtract the previous week from this and get 59.84 for the USC deducted this period. In this example, the gross is 1,000 and is lower than the third cutoff point. We get 0.5% of 231 as usual, 2% of 393.92 minus 231. But the gross has not reached the third cutoff point. We then use the cumulative gross as the third cutoff point, so 1,000 minus 393.92 is calculated at 4.5%, giving us 27.80. In this example, the cumulative gross is less than the second cutoff point. We get 0.5% of 231 as usual, and then substitute the cumulative gross for the second cutoff point. So 300 minus 231 at 2% gives us 138. Take some time now to practice the USC calculations in your workbook. So, we have introduced a lot of different concepts and calculations, and now it is time to bring them all together and to start to prepare for the first assignment. The assignment will consist of completing 3 weeks of a tax deduction card and a USC payroll card to finally find the net pay. It is best practice to do the USC card first. We will then be transferring the final USC figure to the tax deduction card to complete the exercise. In a real-time situation, only 1 week at a time would typically be entered, but, in this case, you can complete all weeks of the USC before starting the tax deduction card. You will notice that the USC deducted this period figure is 22.98 for each week. The USC figure has been transferred to the TDC as shown, and the tax deduction card has been completed as before. The difference this time is that we need to calculate the net pay, and we do this by subtracting the tax deducted this period, the USC and the employee PRSI from the weekly gross to give us a net pay of $635. 02. The final scenario in this section is a mid-year start where an employee does not start on the first week of the year. In this example, the employee has worked elsewhere for 1 week in the current year and starts with us on the 4th week. We have their USC payroll card with the cutoff points, and we know what gross we will pay them. However, this is not enough information to fully calculate the net pay. If we don't know their cumulative gross to date, then we cannot calculate their cumulative gross for week 4. Also, if we don't know their cumulative USC to date, we will not be able to calculate the USC deducted this period. In a scenario like this, we would be looking at putting the employee on a temporary basis of tax until such time as we find this information, and we will explore this option in the next section. In Assignment 1, however, we will be given the previous pay and previous USC as shown, and we can calculate week 4 as before. The tax deduction card is completed in the same way. We will be given the previous pay and previous tax paid to date. Once we enter these in line 3, we can then calculate line 4. It is important to be aware which line you are calculating and which line has the previous pay and tax. Pay close attention to the net pay calculations. Because the employee only worked for 1 week to date, they may have tax and USC refunds. These refunds are added to the gross instead of subtracted. The PRSI is not cumulative and will be subtracted as usual. There is a theory component to the assignment relating to the advantages and disadvantages of manual payroll over computerized payroll. Make sure you do your research on this topic before attempting the assignment. The workbook has practice assignments and solutions. Set aside plenty of time to practice them so that you are fully prepared for the assignment. Pay close attention to the instructions and the allowed time. Once you have become proficient in completing the exercises, you should time yourself to make sure you will not be rushed during the assignment. You will have 40 minutes to complete the assignment, and there are 20% of the total marks available for this assignment.